Ever feel like the financial markets are just one giant roller coaster? Up one day, down the next.
It's a pretty common feeling.
It makes you wonder if there's any kind of pattern or logic to it all.
Right. Like, is there some order underneath all the chaos?
Well, today we're going to dive deep into some research that suggests maybe, just maybe, there are some hidden patterns.
Interesting.
Yeah, these patterns might play out across different speeds in the market. Think about it. From those blink and you'll miss it trades happening every minute,
High-frequency stuff.
all the way to the slow, steady movements that take centuries to unfold.
Wow, that's a pretty wide range.
It is, right. And this research tries to make sense of it all.
So it's not about, like, predicting the next big crash or anything?
Not exactly. It's more about understanding the fundamental way markets actually behave.
Ah, I see. Like the underlying principles.
Exactly. We're going to look at data from all sorts of different sources. We're talking about everything from the very detailed level, 14 years worth of tick-by-tick futures data, to longer-term trends. We've got 30 years of daily futures prices.
Okay, starting to get a sense of the scope here.
But wait, there's more. We've also got an incredible 330 years of monthly asset prices.
330 years, that's going way back.
And to top it off, they even looked at yearly financial data that goes all the way back to medieval times.
Medieval times, that's amazing.
So with all this data spanning centuries, what's the big question we're trying to answer? What's the mission of this deep dive?
Well, I guess you could say our mission is to understand the strategy behind looking at market behavior across these different timescales.
Okay, that makes sense.
And most importantly, to see what this analysis reveals about how markets actually function, how they work.
Because understanding how they work can help us make better decisions, right?
Exactly. It has implications not just for traders trying to, navigate the market, but also for our fundamental understanding of how efficient markets actually are. Are they really as efficient as we think they are?
Thank you for tuning in to Quantopian's Quant Radio, your AI-driven podcast exploring everything related to quantitative finance. If you enjoy this episode, don't forget to like and subscribe to stay updated on future releases. For more quant-focused content, join us at community.quantopian.com. There you can explore a wealth of resources, connect with fellow quants, engage in insightful discussions, and enhance your skills through our extensive range of online courses. Quant Radio is intended to help people develop their knowledge and skills in quant finance. This podcast is not intended to provide investment advice. And now, back to the episode.
So it's like a shortcut to understanding some pretty complex stuff.
Yeah, I think that's a good way to put it.
So, cut to the chase. What's the big headline? What's the key takeaway that emerges from this research?
The central finding is that markets behave differently depending on the time frame you're looking at.
Okay, that makes sense. Different time frames, different behaviors.
Right. So over those mid-range periods, let's say from a few hours to a couple of years, we tend to see trends developing.
Okay, so trends in that mid-range zone. Makes sense.
But if you zoom in to very short time frames like minutes, or zoom out to very long horizons spanning decades or even centuries, at those extremes, the main behavior seems to be reversion.
Reversion, meaning prices tend to go back to some sort of average.
You got it. And there are some pretty compelling reasons for this multi-speed behavior. It's related to how investors behave, and there are some really fascinating theoretical models that try to explain it.
Okay, before we get into the why, let's talk about the how. How did the researchers even begin to make sense of all this data?
Well, they had a very systematic approach.
Okay, good. Systematic is good when you're dealing with centuries of data.
Right. So for the high-frequency stuff, the daily and intraday data, they mainly focused on analyzing the changes in futures prices, specifically what we call log returns, which is like looking at percentage changes.
Okay, so why futures specifically?
They chose futures contracts because they have this thing called a mark-to-market mechanism. Basically means that their prices are adjusted daily to reflect their current value in the market.
So it's like a real-time snapshot of their worth.
Exactly. And that provides a very clean and reliable price history to work with.
Got it. So that's for the short term. What about the longer term data?
For the monthly and yearly data, they looked at a broader range of asset prices.
Okay, so not just futures for that part.
Right.
And I'm guessing they didn't just cherry pick a few markets.
Oh, absolutely not. They cast a very wide net.
Give us a sense of the scope. What kind of markets are we talking about?
They covered all the major asset classes: stocks, bonds, which are basically interest rates, currencies, and commodities.
A truly global mix.
And geographically, they looked at markets in the Americas, Europe, and Asia.
Wow, talk about comprehensive.
And within the commodity space, they broke it down even further. They looked at sectors like energy, metals, and agriculture.
So like oil, gold, wheat, that kind of thing.
Exactly. We're talking about markets like the S&P 500, the German DAX index, U.S. 10-year Treasury notes, the Euro-US dollar exchange rate, and crude oil, just to name a few.
So we've established they've got this huge, diverse data set. But how do you actually measure a trend, and more importantly, how strong it is?
Well, that's where they introduced this idea of trend strength, which they denote as phi. And it's basically calculated as a weighted average of past log returns.
So it's taking into account how much the price has changed recently.
Yes, but with a twist. It specifically focuses on those returns that go above and beyond the expected return for that particular market.
Ah, so it's not just about any movement. It's about movement that's unusual or surprising.
Exactly. And then they standardize it.
Standardize.
Yeah, so you can directly compare trend strength across different markets and different time horizons.
Ah, so it's like putting everything on an equal footing.
Precisely. And they also use a specific mathematical formula to decide how much weight to give to more recent price changes.
Okay, so more recent changes matter more.
Right. It's called exponential decay. And it basically means that more recent price action has a bigger influence on the current measure of trend strength.
So it's kind of like a fancy moving average that emphasizes what's been happening lately.
You could think of it that way.
Okay, so they've got this way to measure trend strength across all these different markets and time frames. What's the next step?
Here's a key part. They didn't just look at each market and each time scale in isolation.
Okay, so they're not just looking at individual pieces of the puzzle.
Right. They aggregated the trend strength measures across all the markets and time horizons.
Ah, so they combined everything together to see the bigger picture.
Exactly. And this aggregation is a really powerful technique.
How so?
It helps filter out the random fluctuations in financial data, the noise.
Noise, right, because there's always a lot of that.
Always. And by filtering out the noise, they're more likely to identify statistically significant patterns that might be hidden if they only looked at individual markets or narrow timeframes.
So it's like looking for a signal in all the static.
A very good analogy.
Okay, so they've carefully measured trend strength and combined all the data. What did they find? What did this reveal about how these multi-speed markets actually behave?
Well, the results paint a pretty interesting picture. Let's start with the very short term, the intraday activity. Everything from a few minutes up to a full trading day.
Okay, so the fast-paced world of intraday trading, what's happening at that speed?
At those shortest time scales, like minute to minute, they observed what we call mean reversion.
Mean reversion, so if a price goes up, it's more likely to go down next.
Exactly. And if it goes down, it's more likely to go up next. They noticed this thing called a discontinuity at the origin.
Okay, that sounds a bit technical. What does that mean in plain English?
They think it's related to the tick size, the smallest increment a price can change.
Right, prices don't move in fractions of a tick.
Exactly. So because of that, you get this slight back and forth movement as the price bumps up against those minimum price increments.
So it's like the price is bouncing off these tick size boundaries.
That's a good way to visualize it.
So could you exploit this to make money? Like buy when it dips and sell when it bounces back up?
Theoretically, maybe you could use this to reduce trading costs, but they point out that it's unlikely to be a profitable strategy on its own.
Why not?
Well, you have to factor in all the other transaction costs, like brokerage fees and such.
Right, those can eat into your profits.
And there's always the risk that a real trend might suddenly start and keep going.
So those little reversals are not a sure thing.
Not at all.
Okay, so let's move beyond those tiny time frames. What happens when you look at slightly longer periods within a trading day, like an hour or a few hours?
That's where things start to get more interesting. After they factored in the tick size effect, they found that for very short scales, up to about 15 minutes, weak trends still tend to revert.
Okay, so those tiny trends are not reliable.
Right. But if you see a strong trend developing even within that short window, it does have some tendency to continue.
So strength matters even in those short bursts.
Yeah, it seems so. And then when you go out to 30 minutes to a few hours, the whole pattern shifts.
How so?
Weak trends in that range tend to persist. There's a positive correlation. But here's the kicker. Strong trends within that same time frame actually tend to revert.
Wow, that's really interesting. So it's like the market is saying, hey, Slow and steady wins the race, but if you're too aggressive, you're going to get pulled back.
It's like a built-in check and balance system. And this actually lines up with what they saw in the daily data as well. It seems like in that 30-minute to a few hours range, you start to see a real trending regime emerge.
So to recap, you've got these very short-term reversals due to tick size, then some persistence in weak trends, but reversion in strong trends in that 30-minute to a few hours window.
That's a great summary.
And what's even more fascinating is that these patterns seem pretty consistent across different asset classes and even time zones.
Right. For time frames of an hour or longer, it didn't seem to matter what you were trading or where you were trading it. The behavior was similar.
So there's some kind of underlying force at work here.
It seems that way. Although this wasn't the case for those super short sub-15-minute scales, those patterns weren't as universal.
Okay, so we've got a good picture of what happens within a trading day. But what about when we zoom out? What about the daily, yearly, and even those centuries-long time scales?
When they analyzed the daily data, a key finding popped up. They found that trends often reverse before they become statistically significant.
So before they really gain a solid foothold.
You could say that.
How did they figure this out?
They used a statistical model, a cubic polynomial, to describe the relationship between trend strength today and the return tomorrow.
Cubic polynomial, so it's like a curved line, not just a straight line.
Right. And what they found was evidence of some persistence in those weak trends.
Meaning they tend to continue a bit.
Yeah, but they also found a stronger tendency for those trends to reverse as they become more pronounced.
So it's almost like the market has a self-correcting mechanism.
Yeah, exactly. Trends that get too strong kind of get reeled back in.
Which makes sense if markets are trying to be efficient.
Right. Now, here's another interesting tidbit. They found that the tendency for weak trends to persist is strongest at around the 3 to 12-month time frame.
3 to 12 months, that's interesting. Why?
Well, think about it, that aligns with the typical time frames many trend-following trading strategies focus on.
So maybe those strategies are tapping into a real phenomenon, but only within that specific window.
It's possible. They also observed that this persistence seems to have decreased in recent decades.
So maybe markets have gotten better at incorporating information and shutting down those trend-following opportunities.
It's a plausible explanation.
Okay, so we've talked about daily data. What about the really long-term stuff? Centuries of data.
Right. So for the monthly and yearly analysis that spans centuries, the picture changes again. For the shorter horizons within that long-term data, let's say 3 months to a year, they still observed that same general pattern. Weak trends persist a bit, then strong trends tend to reverse. And what's really amazing is that this pattern seems to have been in place for at least 150 years.
So shorter-term dynamic is pretty consistent over time.
It really is.
But what happens when you look at trends that last for multiple years, even decades?
That's where they found a reversal of the pattern we saw in the daily data.
A reversal?
Yeah, for those longer horizons, we're talking 2 years out to 16 years. And beyond, weak trends tend to revert, while strong trends tend to persist.
So it flips. That's unexpected.
It is. They think this long-term behavior might reflect things like fundamental economic cycle.
Those slow-moving forces that shape the economy over time.
Exactly. And those long-term structural shifts that happen within industries.
So it's not just about day traders reacting to the latest news. It's about those bigger forces playing out over decades.
Precisely. They also did some analysis of interest rates going all the way back to the 14th century.
Wow, 14th century interest rates. That's some serious history.
And that analysis also supported this idea of long-term reversion, at least when it comes to interest rates.
So even though short-term interest rate movements might correct themselves, really significant, long-lasting trends in interest rates eventually tend to return to some historical average.
That seems to be the case.
Okay, so we've seen all these patterns of trend and reversion across different timescales. What's the explanation? Why does the market behave this way?
Well, the researchers have proposed a fascinating theoretical framework to try and make sense of it all.
I'm intrigued. Tell me more.
They call it a lattice gas model of financial markets.
Lattice gas. That sounds more like physics than a finance.
It is, and the analogy they use is actually very insightful. Imagine the entire network of traders, all the individuals and institutions, as a kind of lattice.
A lattice, like a grid.
Yeah, a grid-like structure where everyone interacts.
Okay, I can picture that.
Now imagine the shares of financial assets being like gas molecules moving around on that lattice.
So stocks and bonds are like tiny particles bouncing around.
That's the idea. And finally, think about how an asset's price can deviate from what its fundamental value might be.
Right, like when a stock gets overhyped or undervalued.
Exactly. They say that's analogous to the density fluctuations of those gas molecules, what they call the order parameter.
So the idea is that the interactions between traders, the flow of information, and the buying and selling of assets can be modeled in a similar way to how molecules behave in a gas.
You got it. And then they connect this whole idea to another concept from physics, self-organized criticality.
Okay, another physics term. Break it down for me.
Basically, it means that markets are constantly being pushed towards a critical point, a state of balance, by the actions of arbitrageurs. Those are the folks who try to profit from any price discrepancies.
So they're the ones keeping things in check.
Right. And when the market's near this critical point, the math of their model actually helps explain that cubic relationship they observed in the market data.
That tendency for weak trends to persist and strong trends to revert.
Exactly. That specific cubic shape is related to something called the Landau potential. It's a concept from the theory of phase transitions.
Phase transitions.
Yeah.
Water turning to ice.
Yes. So they're drawing parallels between how financial markets behave and how physical systems behave when they're on the verge of a big change.
That's a really cool way to think about it.
And what's really interesting is that this type of model might also explain other things we see in financial markets.
Like what?
What are often called stylized facts. Things like volatility clustering, fat tails. Those are about how extreme events happen more often than you'd expect, and the fact that price changes don't follow a normal distribution.
So it's a pretty powerful model if it can explain all that.
It's promising. And it might also explain why those coefficients B and C, which measure persistence and reversion, seem to be pretty universal across different markets.
So regardless of what you're trading, those underlying forces might be at work.
Exactly.
Okay, so much to digest here. As we wrap up, what are the key takeaways from this deep dive into the multi-speed world of financial markets?
All right, let's summarize. First, financial markets don't behave the same across all timescales. There are distinct regimes. You've got very short-term mean reversion, a medium-term regime where weak trends persist but strong trends revert, and then at very long horizons, it flips, weak trends revert and strong trends persist. Second, some of these patterns are remarkably consistent, especially in that intraday to 1-year window, suggesting there are some fundamental forces driving them. And finally, the lattice gas model offers a compelling explanation. It suggests that the behavior of market participants, much like interacting particles, might be driving these patterns of trend and reversion at different speeds.
It really makes you think twice about those seemingly random movements we see in the markets.
Doesn't it?
It's like there's this hidden order operating beneath the surface, but it works at different speeds. Well, thanks for taking us on this journey.
You're very welcome. It's been a fascinating discussion.
Thanks for joining us on this deep dive. We'll see you next time.